But now let's take a different perspective. Let's turn this around and talk about how other important groups are looking at risk assessment and reporting issues, including investors, credit raters, regulators, advocates for new standards in the context of corporate responsibility. We're very lucky today to have with us a group of leaders who will share news about several emerging issues. Each of them will speak individually. We have the table set up over there. Then they'll sit together as a group to speak with each other and take questions from all of you. And again, I remind you about those nice little index cards in your packets. Let's welcome all of our risk and responsibility speakers as they come up to the panel table now. Bios are in your kits. And again, that's Evan Harvey, Katie Schmitz Eulitt, and Laurence Hazell, if you'll join us up at the panel. Our first speaker, and again, I'll just keep talking as you guys take your time and walk up, but please, pass right in front of me, go right ahead. Evan Harvey, Managing Director of Corporate Sustainability at NASDA. As you can see from his bio, Evan is deeply involved in gathering, analyzing, and managing and reporting on ESG data for NASDA, and is their corporate sustainability expert. Evan will be talking about stock exchanges and sustainability, managing materiality concerns, and will share the latest news about the financial and regulatory environment surrounding this issue. After Evan, Katie Schmitz Eulitt, who, thank you so much, she red-eyed in this morning. Katie Schmitz Eulitt will speak next. Katie is Director of Stakeholder Engagement for the Sustainability Accountability Standards Board, also, as many of us know, as SASB. SASB is developing reporting standards for many specific industries and has already released several sets of standards. Katie will share details about emerging SASB standards for 80+ industries, including news about their goals and their latest developments. Then we'll hear from Laurence Hazell. He's Director, Governance Specialist for S&P Ratings at McGraw-Hill Financial. Among many of his credentials, Laurence has been named one of the 100 most influential people in corporate governance. Congratulations. He will talk about managing risk from a credit rating perspective. So now Evan will speak first, and remember everybody, write your questions, and we'll take them towards the end of the session and talk about them during the Q&A session. So with that, Evan.
Hello.
Press that.
How about now?
Yeah.
Okay. Hello, good morning. My name is Evan Harvey. I'll be speaking for a few minutes and I'll pass it on to my fellow panelists. I am the Director of Corporate Sustainability at the NASDAQ OMX Group. That's a two-part job. That means that I manage all the reporting and internal transparency efforts that we use as a public company, but also the education and outreach that we push to the listed companies on the exchange. So one part is how we clean up our own house. The other part is how we push this learning out to listed companies who may or may not want our help. And there are a lot of good reasons why we're here and why we're involved in this discussion and why we've been partnering with people like SASB. And a lot of it has to do with commitment to the principles you see on this poster behind me. NASDAQ has always been a brand that was focused on transparency and efficiency. And so sustainability at its heart is really a data efficiency and transparency effort. It's not necessarily a progressive effort. It's not necessarily an environmental effort. It's all about managing your business better by having more data at your fingertips. And so we absolutely believe in that. We brought that to the financial markets, we hope, but we're trying to bring it to public company strategy and management. When we started getting into this publicly a few years ago, maybe 3.5, 4 years ago now, we realized that we were doing a better job internally with our sustainability efforts than we were talking about. We had a lot of internal reporting. We were using a lot of sustainability and ESG metrics to drive decision making. We had never put it together in an external report. We had done some carbon disclosure reporting, but we had never done anything substantive. So we started to do that first. We looked at the data that we had, and we started to publish our own data to the existing reporting channels. We wanted very purposefully to provide an example for our listed companies of what you could do very cheaply and with a very small team, a team of one, what you could do in order to become more of a leader in this space and to demonstrate the value of the metrics that you would be harvesting. Not because it's fun or because it's a waste of time, but because we absolutely do think it drives strategic decision making. We also saw, and this was 2010, late 2010, that there was a need to drive change right now. We did not want to wait for the SEC to step into the fray. We did not really think that companies were going to spontaneously liberalize their interpretation of how the 10K should be reported. And we also didn't want to wait for our headquarters building up the street to be waterfront property. So that's particularly apropos based on where we are today. So we decided to expand the mission. Not only did we research and report on ESG through the Carbon Disclosure Project, we did a GRI formatted report, we joined and participated in the UN Global Compact. We are now board members of the US network there. We tried to participate in things like the Dow Jones Sustainability Index. We also did the first of a series of annual standalone reports. We drove metrical analysis into the NASDAQ organization. All the executives, it gets bubbled up to a risk dashboard. There are a number of ways in which we put the data in front of people who make decisions on risk, enterprise risk, mergers and acquisitions, market structure, financial products, et cetera. And then we also purposely stepped up our education and engagement with listed companies. We started doing summits at MarketSite in Times Square. We do webinars. We leverage the brand to convene people to talk about this topic. And we also have been facilitating a lot of one-on-ones between high-performing ESG companies and leadership and low-performing. So if somebody comes to us and says, we don't know who to talk to, we don't know how to report, it sounds like it costs a fortune, how do we get started? We have a network of people who list on the exchange who do this well, who love talking about it with other companies. And that kind of learning has gone very well because it's not us coming in telling them how to run the business, it's somebody who's respected in their space is doing a great job and returning a profit, coming in and asking and explaining how they do it. So we also started partnering with experts in the space. We didn't start from zero by ourselves. We worked with SASB. We're a member of their advisory board. We're now one of the first participant in their corporate roundtable trying to drive ESG reporting into our 10K. We've been actively involved in the standards creation through the Financial Services Working Group. I mentioned the United Nations Global Compact. We've hosted the Integrated Reporting Council at our market site. We've launched their framework at our market site. We've collaborated with NGOs and investor advocacy groups like Ceres, the Investor Network on Climate Risk. They came to us a couple years ago and said that exchanges should be doing more, and we took them at their word and said, come back to us with a proposal for what exchanges should explicitly require from companies. That proposal is out there now and open for comment. And then we wanted to expand it even more. We thought, how can we take this message that we've delivered internally and we've pushed to 3,000 companies on our own market around the world? So we have joined the United Nations Sustainable Stock Exchange Initiative. There are 10 exchanges in there currently. NASDAQ, NYSE, London just joined, you may have heard, Brazil. It's a discussion and event forum. It is meant to engage investors, regulators, and companies on ESG performance. It's the way to improve your performance in this area. Beyond that, we saw a need for exchanges to get into this in and of ourselves, our own business needs. So through the WFE, which is the World Federation of Exchanges, it's the only connective tissue that binds all the exchanges, or almost all the exchanges in the world together. 60 of them, just about everyone you've ever heard of, except for LSE, but we'll skip that. We decided to push for a working group to make this part of the official agenda for stock exchanges to look at in terms of improving their own business. The WFE is formed to improve the business of stock exchanges, to make them more viable. So 18 exchanges stepped up to join this working group. It's one of only 3 working groups at the WFE, so it's a good indicator of where the priorities are in that organization. The sustainability working group is 1/3, statistics is 1/3, and cybersecurity is the other 1/3. So those are the 3 issues that stock exchanges around the world have identified as key drivers for their business. So 18 exchanges have joined our working group so far. That's 18 of 60, almost 1/3 of the capital world. A lot of exchanges that you know: NASDAQ, NYSE, Toronto, Tokyo, Johannesburg, Brazil, Shenzhen, Istanbul, Egypt, Deutsche Börse. We also have exchanges like CBOE, CME, and ICE, so we're looking at the futures exchanges too. This isn't exclusively about compelling listed companies to do better. This is also about how you bring more sustainable financial development to the markets. And then, what is this meant to do? The idea behind the working group is very specific, and I'm actually going to read you our mandate because if you know the space, everybody loves the manifesto. And this was very carefully worded, but the working group in the course of this year will deliver this work product: a recommendation in the form of a short white paper or brief to the general membership of the WFE for vote and or debate in October, discussing 5 points. 1, the material need, if any, for stock exchanges to seek, standardize, and publish ESG data from their companies that list on their exchange. The most effective form and framework for the delivery of that data, whether it's SASB or some other framework. Our estimation, our collective estimation of the possible business impacts, positive and negative, not only of making this data more transparent, but becoming the vehicle of that transmission ourselves. General recommendations concerning the role of stock exchanges in the formation and sustenance of a fair, open, and transparent economy. We got that one added. The leverage that exchanges may hold in promoting more sustainable business models. So it's a fairly lofty goal to get 18 exchanges to agree on those 5 points and to produce something that is short and sweet, and that the exchanges, if they agree, will take it back to their home market, localize, decide on the proper enforcement. We're not going to dictate whether this should be a listing rule or whether this should be a comply or explain or whether this should be a phased-in approach. They are the best judges of how best to implement it on their market. The idea is, if you are going to solicit, and we think you should, ESG data from your companies, these are the ones that we think are the most material to our business, and these are the ways that you think you can get it from them. And then just to leave you with a bit of a depressing thought, why are we really involved in this? Why do we think this offers the most promise? Because the data is still bad. I mean, we could talk about performance, but I think that the current state of data is still very bad in terms of corporate reporting. If you look at just some general numbers that are out there, the S&P 500 analyzed by the G&A Institute, about 53% of them do some kind of CSR report. 47% of the S&P 500, the largest, the best large cap index benchmark, do nothing. 2/3 of that group who do report use GRI, 1/3 use some other format. Food and beverages and energy are at the top end. Financial services, I'm sad to say, at the low end. And then you look at the GRI database, which is the most prevalent global standard for reporting ESG metrics. 2,401 public companies reported in 2013. If you look at the exchanges I just mentioned on the WFE, there are 43,000 public companies listed. So only 5.5% of our possible reach are reporting right now. That's pretty dire. And then if you get into integrated reporting, and we can talk about this a little bit later, the numbers are even worse. 249 worldwide, only 7 companies in the US. So we think that the WFE working group offers a significant opportunity to move things forward. We're leveraging our brand and leveraging our industry where we think we can, and we're partnering with great people like SASB to try and figure out the best format and framework for the data and the analysis of the data.
Thanks, Evan. Great setup. We did not collaborate on it. But it's absolutely true in the U.S. that the current state of disclosure, although companies are doing tremendous things, absolutely tremendous things, only 420 companies, and I'm not even sure how many of those are publicly traded, are currently reporting using GRI data. And there are 14,000 publicly traded companies just in the U.S. So the current state of disclosure on these issues is less than robust. And why? So what? Why should anybody care? And the reason that every company should care about this is that investors are increasingly interested in this. Investors see transparency on environmental, social, and governance, or ESG issues, as a proxy for good management. They see companies that are performing well in these areas as leaders in their industries. They've intuitively known, if you talk to fund managers at BlackRock, they'll tell you that, I've known for a long time that if a company is on the top 100 companies list, they're going to outperform their peers. And we see increasing evidence to that effect. So for quite a while, this has been seen for proxy for good management. The companies are seen as being better managed and forward-thinking and explicitly better at managing and mitigating risk. And so SASB is working on creating industry-specific standards for the disclosure of environmental, social, and governance issues, because one size does not fit all. Climate change does not manifest itself the same way for a healthcare company as it does for a financial company. So if you look at SASB's work, which to date we've convened industry working group members, we've had 1,600, I see many of you in the room who've been in our working groups, among them Evan and others. So 1,600 industry working groups. We've issued standards. We have 19 industry standards out there in the world. By the end of June, we'll have 30. By the end of the year, we'll have 49. We're about 40% done with all of the sectors that we'll be covering. So we're moving pretty rapidly to get these standards out the door. And again, why? Investors increasingly are interested, but they're also really dissatisfied with the current state of disclosure. I've most recently had an investor say, I'm tired of having to go on a treasure hunt for this information because it isn't
in one place. It's in your sustainability report if you have a sustainability report. It's sometimes on your website if you have a sustainability section on your website. Investors want comparable data. That's what I hear again and again. And survey after survey, ACCA surveyed investors, 92% of them were dissatisfied with the comparability of data. 80% of investors surveyed by PwC were dissatisfied with the ability to compare data. Ernst & Young issued or a report on an investor survey that indicates investors do care. For many years, we would hear, oh, investors just don't care about this. Investors do care, but when they come to you with a question on your quarterly call, they don't say, okay, here comes your ESG question. They're asking you about energy efficiency if you're in an energy-intensive industry. They're asking you different things. If you start to listen, the questions are there, and they are going to become louder. The drumbeat is getting louder and louder and louder. And that is for many reasons. We live in a changing world. The SEC was born out of a crisis in confidence in the markets after the stock market crashed in the 30s. FASB came in a crisis in the comparability of financial data. That came to us in the 70s. Since the 70s, the world has changed dramatically. We have 7 billion people we need to feed, provide jobs. We need to figure out a way, because we're soon going to be at 9 billion. We have resource constraints that are related to not only the population boom, but changes in demographics, the urbanization of that population, coupled with climate change or extreme weather or whatever you'd like to call it. So there's been an absolute explosion of interest in this area, and there's now a proliferation of ways that companies are struggling to cope with communicating how they're performing on these issues. So the comparability isn't there. And so SASB standards are designed for the disclosure of these issues, but before you can disclose them, you have to manage them. And I think that's something that's often lost on people when they're talking about SASB. First, they think that it's prescriptive. SASB is guidance on, if you're in an industry, we have evidence that indicates that these are the areas where the gears connect. These are the areas where you can prioritize the key value drivers for your business. And once you manage that, you can then analyze the data and determine whether or not there is in fact information that would be material to your investors. That's what this is really meant to do. So in our analysis of the industries that we've covered thus far, we've determined that of the data that is there, about 80% of it is not material. It's related to really feel-good operations from time to time, which doesn't make them unimportant, but they aren't related to the key value drivers of a business. So, for example, for the electrical equipment manufacturing industry that we're currently analyzing now, for one of the largest companies, whose name will remain nameless, there are 400 plus data points in Bloomberg where an analyst might go for information. 400 data points related to ESG. When we put them through our materiality assessment at SASB, only 8 of them were material for investors, where the impact on the business is evident. It doesn't, again, mean that the other 300 plus are unimportant, that people don't really care about them, and that over time they might become material, but right now that's not where the gears connect. So we're really trying to create a platform through which companies can prioritize key value drivers that are related to environmental, social, and governance issues, and then communicate that with their investors so that they can be rewarded for that great behavior, so that we can create a race to the top on sustainability instead of having it be just a compliance problem, which is the way many companies in the past have begun their journey on sustainability. Really, sustainability is about resilience. It's about the ability of a company to thrive and adapt to a changing world and to meet different expectations of a new generation of millennials who have very different expectations about what their employers are going to be giving them, about how they want their money to be invested. They really want to walk the talk. They want to be able to find funds that really are invested in a way that they believe the world should run. And we live also in an age of incredible velocity of information. which makes protecting your brand a real challenge. I just came from Sustainable Brands, and there was a group of activists that literally slipped under the door of everybody at the conference propaganda indicating that companies X, Y, and Z are basically destroying the planet.
That's how to make friends, isn't it?
Yeah, so yeah, that's really, that does a lot. So, but the point being that things can go viral, you know, and I think Warren Buffett said it best, you know, it takes years to develop a reputation and 5 minutes to destroy it. And it takes even less time now than it did 5 years ago, perhaps, or whenever it was that he said that. So it's imperative for companies to manage these issues, first and foremost, for themselves and their ability to continue generating value for their shareholders, their employees, their communities. It's a giant puzzle. And it's extremely important to figure out where the rubber hits the road, where the gears connect on these issues, and then communicate it back out to your shareholders, your stakeholders, and everyone else who's now listening in. Everyone's leaning in and wanting to know how companies are doing. So.
Okay, well, perhaps I'll use this one to make sure it doesn't run out. Hello there, can you hear me? Is it working? Hang on. Can you hear me now?
Yes.
Good. Okay, thank you. Well, Evan and Katie said they didn't actually kind of collude, but we did have a pre-call just to make sure that we were all on the same boat, so to speak. And I have to tell you, one of the things I thought was going third is going to be formidably difficult behind those two speakers. So they both said some really important and kind of some very important and interesting things. And I'm going to try and make some observations from a credit rating agency sort of perspective as well. I don't know if you've seen, but actually we had a big round table at S&P, and at the back of the room or somewhere there are a bunch of Credit Week special editions that is on actually the topic of climate change and its impact on ratings, from sovereign ratings, that's the ratings of countries, all the way down to companies. So I brought as many copies as I could carry. Collectively, they're quite heavy, actually. I'm not sure about the environmental sustainability of publishing that in such a form. It's rather glossy paper, which is always a lot heavier than everything else. But for any of you who are interested and who are disappointed because my arms weren't strong enough, I also have a PDF version as well, so I can share that with you afterwards. So, in essence, we're here to discuss what our hosts have characterized as the new materiality mindset. I think that is at the heart and at the center of what the BBB have done today, and I want to say at this juncture, thank you very much for the invitation to come and speak to you. Now, in their different ways, Evan and Katie are at the sharp end of that process. You've just heard from both of them. I mean, I would say they're at the tip of the spear. You know, you have publicly listed entities on your stock exchange. You are proselytizing and creating proper sustainability metrics. A rating agency? Well, it has its has its impact and influence, to be sure. But I think of us rather as evaluators of, rather than champions of these kinds of new initiatives. What we have to do is try and see what impact it will have on our outlook and on the rating of the issuers that we rate. That's really what we have to do. That's what the market expects of us. And so therefore, while we'd love to join the bandwagon, we sometimes have to be a little bit careful and a little bit cautious about that, particularly in light of something you said, Evan, which is that the data just isn't there yet. And as a credit rating agency, you can't go around either handing out bunches of violets or something worse to issuers simply because they claim that they're doing this, that, and the other. There's a big kind of reality gap. Do you remember where the word credit comes from? Most people tend to think of credit ratings as you have a bunch of financial ratios, free operating cash flow, debt outstanding, EBITDA to net debt, all the rest of it. And you put all those together, and out pops a credit rating. That's not how it works at all. The word credit, remember, comes from the Latin credere, to believe. And actually what a credit rating is really also an opinion on the believability of what you're telling us. And no amount of financial metrics, no amount of avowals of good intention, no amount of bluster and nonsense will ever take that away. So I'd like you to bear that in mind. So, this new mindset. We're a credit rating agency. We're not out at the front of the charge like my two co-speakers. So I want to tell you, and it's a little bit of a mea culpa really in certain respects, how we were impacted by this new materiality mindset as we devised what I had to take a particular responsibility for, which is itself something of a new thing. And this was the management and governance credit ratings criteria. As you might imagine from my job, I had quite a big hand in doing that. So some of you may or may not be familiar with what a credit rating is. And this is by no means going to be a learned disquisition on it either. Essentially, at bottom, credit ratings are one of several tools that investors can use when making decisions about purchasing bonds and other fixed income investment. A credit rating, then, in essence, is an opinion about credit risk. Our ratings express S&P's opinion, and Henry Schilling is over there, Moody's, about the ability and the willingness, and both are important, the ability and the willingness, be that a corporation or a state or a city or a bank or an insurer, to meet its financial obligations from those bonds in full and on time. Now, there's a lot more complication than that, but that basically is what a credit rating is an opinion about. As you all know, they're summarized in letter grades from AAA down to D in the case of S&P, but they are also very importantly expressed in the rating rationale, which actually underlies the ascription of that. And I think where ESG kind of materiality, the new materiality, is going to particularly show up will be in how we arrive at the rating which the credit rating rationale provides. Now, being S&P's governance specialist, you're not going to be entirely surprised when I say that where we consider managing risk and creating value, which is what our first speaker spoke about so eloquently today, is in the management and governance credit rating factors. Actually, issues about sort of managing risk and creating value imbue the entire ratings process. But this isn't the place, and 15 minutes ain't the time, where I can go into all of that. It's, if you've ever read our credit ratings criteria, well, I'll see you in the recovery room, okay? So I just want to be clear about that, all right? And how it came to us is this. We put together a draft of these management and governance criteria. They took many iterations even to get to that draft. Just think about it. A credit rating agency is where you build credit opinions. How you build credit opinions is you have lots of very opinionated people with different opinions arguing about what the credit rating should be. Imagine an environment like that, just how easy it is to write anything at all which anybody else will agree with. So that really is the nature of the enterprise. Actually, the final version of the criteria were published right after Hurricane Sandy, at a time when the lobby of this building, and you may have noticed that S&P is right next door, so I couldn't claim I had too far to travel to attend today, was under 5 feet of water. To get here today, we'd have had to swim to these seats, okay? That's what it was like. And it also turned out that the name Water Street is a pretty good description as well. So, you know, a lot of learning. But I have to say that what happened through the criteria writing process, and then Hurricane Sandy itself, which I think most of us, certainly in the New York region, won't be forgetting quickly, made a big impact on me, and I think on a lot of other people as well. So, credit rating criteria. Well, as I've told you, criteria can be a bit of a scary word. And frankly, looking around this room, I see you as a pretty happy and well-adjusted bunch, so I'm assuming, apart from Henry over in the corner, you don't have too much acquaintance with what the criteria really means, okay? But what, sort of joking aside, criteria really do is they provide an analytical framework for ratings analysts to work through when assessing credit risk. It's a roadmap. It's a guide. It doesn't determine the rating. It's meant to provide you with the framework where you can answer the questions about what that rating should be. Believe me, with my own background in academia and the law, I learned the hard way that criteria writing in a rating agency is not a literary exercise, okay? It's the making of a workbook. I've still got the scars, all right? So, in other words, criteria encompass broad principles. The ratings factors that are specific to the entities we rate, you were making the point, Katie, that what will be so for an electric sort of utility wouldn't be so for a company, making shirts or selling shirts or anything else. And these are then the assumptions that we make in our analysis of creditworthiness. So it's principles plus methodology that guide analysts. And because we publish our criteria, that informs the users of ratings and market participants generally on how we arrived at credit rating on X Corp, Y Bank, or Z Insurer. Now, to be sure, X Corp, Y Bank, and Z Insurer most of the time think their credit rating is far too low and can't believe how we ever arrived at the rating we did. But guess what? That just goes with the territory. Now, I'm not going to try and summarize the credit rating criteria to you. Suffice it to say that many of the things that both of you have discussed today, really are the things that we look at. And I know that, you mentioned governance at the end of the keynote speech, and that's certainly obviously my own particular bailiwick. And again, you can have 60, 70, 100, 1,000 governance factors that you can look at. But essentially, we boiled it down to what we think are the 7 most important. And I'm just going to briefly tell you what they are. We can pull it up in more detail. Board effectiveness. The board is the ultimate controlling mind of an organisation. Entrepreneurial or controlling ownership. Unlike Evan, we rate a whole lot of entities which are not publicly listed, and so therefore we have to look at the ownership profile and the degree of control which is exercised there, in the sense that we're looking at whether all stakeholder interests are being properly looked after by a bunch of people who really do have that degree of control. Management culture, not talked about so much in terms of governance sometimes, but absolutely critical in our view. Regulatory, tax, or legal infractions, and this is as the new materiality mindset coming together, the conflict minerals issue. We will be looking at those kind of infractions, those failures, because they tell you that there are failures in management culture and perhaps in board effectiveness as well. Communication of messages. One of the things, if any of you have a credit rating, do not tell a credit rating agency one thing and then go and tell other investors something else, okay? Consistency of messaging is really pretty important. The internal control environment, that's game, set and match. I'm sure you all agree with that. Financial reporting and transparency, you touched on that, and that is absolutely, for a credit rating agency, sort of a fundamental and critical issue. Now, because a rating agency can impact the cost of capital, as I said earlier, we just don't put criteria out there without getting comment and feedback from market participants first. When we published these draft criteria, we had a lot of comment, and actually had to extend the comment period to accommodate all the things that people wanted to say. Now, relative to our discussion today, one important piece of feedback was that we had not paid sufficient attention in the draft of the criteria to the management of environmental and social risk. It was essentially, you've got the G part, guys, but you're missing the E and the S. There was one letter I'll never forget. It was actually addressed personally to me, which I was just like, really? And the signatories were investors who'd signed on to the UN Principles for Responsible Investment. Well, because the letter was marked private and confidential, I can't really reveal who said what and what they said and all the rest of it. Let me just put it this way. It got the attention of the folks next door because collectively they represented investments that were in the trillions of dollars. Okay, you pay attention when you hear those kinds of figures. Anyway, we then included under our risk management factors the management of environmental and social risk. Now, that's just 7 words. You could say, S&P, aren't you guilty of the very thing you say that some of the issuers that you rate are, which is they just pay lip service to it. They think they can just put it out there and be nice about it, and that's the end of it. Well, you're going to have to be the judges of that in the Q&A that's following right now. But what we tried to do is take on board the fact that we had been, I believe, rightly criticised effectively, and the change that we'd made as a result of that criticism. And I'm just going to conclude by reading to you what we decided to publish in a sister publication to the criteria. It's this. What about ESG? Why were social and environmental factors not considered originally? And here's our response, largely written by yours truly with his tail between his legs. Anyway, we received, I say, significant feedback about the role of environmental, social and governance factors as a source of material risk to corporate financial performance. So, hear that right away. The criteria at S&P now include looking at this. We were reminded, I have to say to you quickly, the word reminded was a little bit of a facon de parler, okay? That matters like climate change and employee relations are no less risks to an enterprise than, for example, deficiencies in management expertise or board effectiveness. We found the feedback persuasive. You get a letter with many trillions of dollars behind it, that's persuasive. And all the more so, and this is where we needed to catch up ourselves, if you will, in the context of initiatives that Standard & Poor's has taken, for example, to promote global consistency and analytic rigour in matters like climate change, clean energy, and the impact of regulations restricting the emission of greenhouse gases. That publication I mentioned to you at the back is essentially one culmination of those enterprises. Consequently, we say, and I feel very much like an old barrister here defending, a rather miscreant defendant, okay? Under the comprehensiveness of risk management standards and tolerances sub-factor, my God, don't we speak well, we have added specific reference to the management of environmental and social risk. So, there it is. It's a beginning. It's not a terminus. We're going to be listening to all of you, my co-speakers, and that's the way we're going to go forward. But it's on the radar screen, and in my opinion, it ain't coming off. Okay, he's got a question for me. Okay, Evan.
Okay, so the cost of capital argument comes up a lot. In terms of how S&P works and the downstream effects of your credit ratings taking more sustainability factors into account.
Yeah.
Wow, look at that.
I know.
This will be the softball. How do you see the future of cost of capital decreasing even more based on high performance in this area?
Well, I think you pointed out something, or actually was it Katie who was mentioning that companies who do very, very well in these areas tend to have that reflected in stock price. Well, remember, you couldn't have creditors unless you had equity owners. So the fact that the company is run well and gets some enhancement to its stock price, I think prospectively that could mean that its cost of capital will decline. To the extent that a rating agency has some influence on the cost of capital, I think that's a work in progress. I think that we've got these criteria out there, but there's sometimes a gap between cup and lip, if you will, between publishing criteria and actually getting the right kind of impact. Frankly, I'll tell you what it's going to take. It's going to take a couple of horrid shocks, okay, where we've got a BBB rating on something, where suddenly some ghastly thing occurs, and then, oh my God, yes, we had these criteria all along. Pull them out of the drawer and let's get started. Quite honestly, I wish it wasn't that way. That's what I think will happen. And that will be an impact on the cost of capital. And as you both mentioned, the world has changed. People are looking at these things in a way they haven't done so before. So we've got to as I say, I think we're still playing catch up, but my job is to make sure that the next ball we catch is in centre court.
Just a follow-up on that. When SASB is looking at research, and it's a very lengthy process when we go about setting standards for a given industry, but we look for evidence of interest in a given topic for companies in an industry, and then we look for evidence of the financial impact of those issues on companies in an industry, including, has there been an adjustment to the cost of capital related to X, Y, or Z? Have there been stranded assets, and so on and so forth. So yeah, we're playing catch up as well. I will read this, not knowing how it ends. I don't know who this is for. Oh, it goes on to the back. Okay.
We have a manifesto.
Why, when sustainability as a policy to which the U.S. federal government has supported, but the policy is rooted in the UN's Global 2000 agenda, which is the population reduction agenda, controlled by those who believe the world is overpopulated by 8/9, why do organizations ignorantly adopt or covertly, willingly support, rather than exposing and rejecting it? Its policies and strategies, such as permitting growth and use of GMO grains, associated agriculture, and these terrible, dangerous herbicides, which turn agricultural land into Superfund sites. This is what sustainability is. Why support this as opposed to exposing this co-opting that is designed to get buy-in to reduce the world's population by 8/9 and expropriating or eminent domaining their resources using these insidious means? Well, that's a simple question.
All yours.
And I don't know that any of us up here is really qualified to answer that question. That's, I don't even know where to start.
Well, I'll just say, I mean, we get involved where we can get involved, where we think we have the most effect. We're very pragmatic in that way. There are a lot of associated problems in the sustainable space, a lot of company issues, a lot of greenwashing, a lot of outright manipulation of data. But where we're starting from is the leverage that we have, which is compelling more data. Even if it's bad data, even if it's not good data, we need to start from somewhere. So if companies purposely disclose bad data or they have bad practices, eventually that will out. We really do believe that. Starting from a state of zero where companies don't have to or choose not to say anything doesn't move the ball forward.
No, and I do really think it takes all the oars in the water rowing in the same direction. And so you can go where you can, as NASDAQ SASB goes, where we can go as a standard-setting organization confined by the constraints of U.S. securities law, and and it doesn't allow us to expand beyond that. But there are plenty of organizations, like the organization that slipped things under my hotel door at Sustainable Brands, that can identify these things and can get them on the radar and increase the pool of evidence of interest, and then perhaps have an impact on the earnings of companies. I mean, it's all part of a giant puzzle, as I mentioned previously. You have a couple of questions.
I've got a couple of questions, and okay. So my first question here is: let's say I were an S&P analyst in the public sector division. How might I discuss ESG risk as it relates to a municipality? Also, how might I demonstrate to the committee that the information is believable? So let's answer the second bit first. I think that's a very, very critical issue. It goes back to the point that you made, Evan, which is, is the information good enough yet? I don't think it is. But a credit rating agency rates a lot of different things, and the quality of the information is one of the things we perpetually have to take into account. So what we do is we look at comparables, we build portfolios, and then we say, well, wait a minute, if X municipality can give us this information and it's similarly sized, similarly funded, and all the rest of it, why can't Y? So there's always a little bit of catch-up going on there. So I think that information is going to get better. I think all the tools that we have at our disposal will make it so. Will municipal finance have the level of sophistication and clarity, which even itself is problematic for large publicly listed corporations, in the near future? I don't think so. Could they do it? Yes, I think they could. Will they do it? That will depend on all sorts of things like funding. But Just because it can't be done now is absolutely no reason why it can't be done in the future, and that's precisely what my co-speakers here are really advocating in their various ways. So, let's assume you were an S&P municipal analyst. Well, one of the things I should have said is that when you start out on a very large criteria enterprise in a sort of rating agency as big as S&P, you can't bite it all off in one big chew, okay? So after the 2008 financial crisis, our own banking criteria went through an enormous series of rewrites and all the rest of it. So when the first publication of the management and governance criteria came out, it related to corporate enterprises and insurers. Believe me, that's no small slice of the capital markets. That's every corporate entity that isn't a bank and every insurer as well. About $50 trillion worth of obligations, something like that. Now, we have not made it apply yet to the municipal actual arena, which is another huge area where the methodology is somewhat different and all the rest of it. Could it be applied? Yes. Should it be applied? Yes. But just remember, little old Laurence Hazell speaking, the governance specialist, he would say that, wouldn't he? But absolutely, I think, as sort of, when you think about it, the actual corporate form began as a local authority. Remember, the corporation of the City of London? Absolutely it can apply, and it should, and in due course I believe it will. And you know what it'll do? It will help municipalities deal with the cost of capital. If you can see that kind of management of risk, you will see a better return, and you will have a better credit rating and a lower coupon rate. So I've answered one question. So is there anybody else with a question?
I actually received a correction to my own remarks. Yes. GNA this week has released new research updates on the 2013 S&P 500 reporting standards.
Oh, right.
The number is now 72% of S&P reporting. So since we've been here, we've been driving things forward.
Wait a minute.
72% of the S&P 500 now.
And your first
number is 54%. So my numbers for 2012, this is 2013.
You know that word credibility I mentioned? That's an enormous difference.
It is. But, we're also talking about the 500 largest and most capable companies in the United States. The fact that 10 years into this struggle, a little more than 2/3 of them have seen the light, bully for them.
Okay.
And then there's a question on here for Katie, too.
Oh.
What will SASB do to work together with existing global standards? So basically, how do you harmonize? How do you integrate?
We're working through a group called the Corporate Reporting Dialogue, which was originated by Paul Druckmann, who also chairs the IIRC, who gives us integrated reporting. But they're seeking an independent chair, and I don't really know how that's developing. But we also have regular conversations with integrated reporting. We have an MOU with the integrated reporting group that basically talks about the overlay between SASB looks at 5 capitals. We look at environmental capital, social capital, human capital, business model and innovation, as well as leadership and governance as the 5 buckets into which we sort the universe of sustainability issues. Integrated reporting looks at 6, and there's a tremendous amount of comparability. So SASB's stance is that when you begin to use SASB standards and you begin to provide material information in your filings to the SEC, you're on a path towards the integrated thinking that's called for in integrated reporting. It's not an integrated report, capital I, capital R, but it's a path towards that. And the SEC hasn't said if you issue an integrated report, you don't have to do your 10K, and I don't think they will. That's not the way things work here. So we're working with them. We're also in conversations with GRI, but it's really important for everyone in this room to understand that GRI and SASB aren't competing with one another. They're not analogous to one another. If you will, SASB fishes from the pool of evidence that we get from a broader engagement with a broader group of stakeholders, which is what GRI has always done for the 15 or so years that they've been in existence. They have been promoting broad engagement with wide groups of stakeholders. When SASB looks at issues that are likely material for companies in a given industry, we're looking at that evidence of interest, but then we're screening it for evidence of financial impact. We're screening it for the definition of materiality that we get from the SEC, which comes from the Supreme Court, which is what would the reasonable investor want in the total mix of information made available? And so it needs to be a narrower set of issues. So you can't, I've often recently used the analogy that it's sort of like a series of nested Russian dolls. SASB's the one on the inside. If you did nothing else, start there, because that's where the key value drivers are. And if you want to do a more expansive disclosure, a more expansive report, we applaud that. That's great. But EU legislation aside, where now European companies are going to be required, companies over 500 employees, I think it will affect 5,000 to 6,000 European companies that need to do a certain kind of reporting. In the US, we have jurisdictional specificity of US securities law here, so we need to, that's what SASB does, is to take those other things and fit them through the keyhole or clear the hurdle of securities law that we have here. So, anyone else?
Yes, I have another question. Would appreciate my views on best practices in integrating environmental and social risk into enterprise risk management practices and processes. Okay, sit back. No, I'll obviously have to be brief because I've actually got a hot potato question over here, which I'm hoping I had sort of time run out on me. But anyway, let me answer this briefly. Environmental and social risk for most companies, and in most companies I would include people like banks who very often think they somehow don't have any environmental and social risk. Actually they do, it's just a one remove, if you will. Their lending decisions and all the rest of it have a huge impact on environmental and social risk. These things aren't to be integrated, they should already be there, quite frankly. The management of these risks is part and parcel of it. And another thing I want to say is, people tend to think of ERM, because it's risk management, as something which is almost, if you will, kind of compliance driven, okay? Actually, managing risks successfully creates enormous opportunities for companies. And the thing to remember is that when you create those kinds of opportunities from a credit rating perspective, you're probably going to be increasing the likelihood that your rating might be higher than it otherwise would. It's also, therefore, going to possibly decrease your cost of capital, but you're going to be running a more efficient and effective organization with more potential for growth. So it's really worth looking at it from that point of view. Now, to be fair, I better go to the hot potato question, okay? If you don't mind, guys. The EU recently announced a new audit rules requiring companies to change audit vendors every few years. The rationale being auditors and their clients had grown too cozy. Here's the bit I didn't really want to answer. Do you think the same applies to credit rating agencies, or do you think they are independent of such sentimentality? Independent? Incapable of being influenced? Really? No, of course not. Okay? What we have are practices and processes in place. One thing is analyst rotation. We're a business at the end of the day. Of course, there was that sort of proposal that the government would hand out credit ratings on some kind of basis, way or form. Okay, if you want to go down that route, please go ahead, you know, tell your elected officials. What we do, though, is a number of different things. First of all, we do have an analyst rotation policy. Now, that has actually created more trouble than it's solved, because, you know, you have an analyst who knows a very big company very, very well, and at some artificial point you say you can no longer be the primary analyst on that company. Believe me, you create business interruptions, both for them and for us, which are formidably difficult to deal with, and misunderstandings arise. Secondly, remember this. No credit rating is ever assigned by an individual. It's a credit rating committee. And the committees I've been in are not full of patsies. I'll give you an example, okay? You know that, rather embarrassingly, somebody mentioned that I was once named among the 100 most influential people in corporate governance. Well, let me tell you, credit analysts are a nasty bunch of skeptics. And the kindest remark that was given to me at S&P when this came out, which is about 6 years ago, was, well, Laurence, you must be really pleased it wasn't the 99 most influential people in corporate governance. And that was the kindest thing that was said. So this is not going to guarantee an answer to that question, but all I can tell you from my experience at S&P is it's a pretty robust process. I always say, because we have a great advantage which other market participants don't. We meet with management, okay? Do you know what the colour of the carpet is on the big floor? It's red, so you can't see the blood, okay? So I just want you to bear that in mind. This is not a convivial, oh, yes, of course you'd like a triple B, well, here it is, type of process at all, okay?
That's great. I have a question here. How should one be thinking about the differences in the roles and objectives of FASB and SASB? FASB and SASB are not associated in any way. We're not a subset of FASB, although we do try to pattern ourselves in terms of our processes and standard setting. FASB has taken several looks at managing environmental, social, and governance issues through their framework and have stepped back from it each time. And that is why SASB exists, because FASB gives us GAAP. FASB gives us the guidance for financial reporting. What SASB is trying to do is to raise the level of rigor through which companies can manage and disclose these issues in the Form 10K, specifically in the MD&A section of the Form 10K, which is meant to give investors a view into the corporation through the eyes of management, through the analysis, particularly the A of the MD&A. So what are the risks and opportunities do you see looming on the horizon? How are you managing them? What are the challenges? And how are you going about that? So that's really what we're trying to do. And if I didn't answer your question properly, then please find me before I run off to our board meeting after this.
Well, this is an easy one because they gave me the question and the answer in one card.
We just have to read it out then.
Yeah.
Okay.
Why is comparability an issue when the majority of sustainability reporting companies are already using GRI? And then they have in parentheses, or is this more of an issue, Ray, the quality of the info? I think it is more of an issue, Ray, the quality of the info. First of all, although GRI is the most prevalent global standard and it's the one that it's been established the longest, and it's the one that companies tend to gravitate towards, and it's a fairly broad standard that offers a lot of opportunities for reporting. It's not, by the numbers that I've cited earlier, it hasn't penetrated most of the corporate world. And the data that is there in the GRI is wildly divergent, sometimes inconsistent, sometimes outright inaccurate, purposefully or otherwise. So I think that the answer that the person put on this card is absolutely right. It's more about driving more quality into the info so that it can be comparable across companies, rather than saying, well, you said X and you said X, so I'll take you at your word.
I think everything too boils down to this. It's great to move forward, it's great to have these kinds of initiatives, but don't forget the realism at the end of the day. We have so many issuers that come to us with great aspirational ideals, but you've got to have the wherewithal to put some small subset of them into practice. Sadly, I can't stay for all of today because I've been suddenly called into a meeting with a company that, let me put it this way, has had more than its fair share of troubles recently, okay? And here's where the realism issue comes alive. So eventually we got hold of them and they said, we've got an action plan. And the action plan was 51 points long. And they said, we're going to have this done by the end of the month. And I said, but it's the 7th already. And then I realized when I read through the action plan how they might just about do it. According to them, April has 31 days in it, okay? So, don't go to a rating agency with that kind of thing. Don't go with empty aspirations. Really make it make sense. Integrate it. Remember, it's all wonderful to have it, but integrate it into the business and financial risk profile of your company in a way that really makes sense of doing it, having commitment to it, engagement about it, and most important of all, seeing it through. The times we've heard things. One of the things that we really look at is the strategic competence of senior management. And if you're constantly changing from this plan to that plan to doing something else, I'll tell you, there will be an impact on your credit rating and it won't be going north, okay? So that really is something to bear in mind.
Well, that's kind of a great, I hope we have time for this question. A great setup for this question, which is what will it take to get more companies reporting with comparable data? What drivers will prompt it? Is EU action going to push that? And I think we've all been talking about and what we've heard about, companies are beginning to realize that these are business issues. This is, I think, a company recently said, sustainability sort of gets in its own way because it creates reflexive responses depending on the company that you're speaking with, and they think that you're busy hugging trees or, eating granola and are, really just, believe in unicorns and,
Rainbows.
Yeah, exactly. But the data that investors are beginning to present to us is that they're now beginning to see this correlation between better transparency and better performance in companies. And the more data that we get, I think we will soon see correlation there. We'll have sort of the facts present themselves to management. And to get companies to begin reporting more comparable data, you have to have the standards to do it. So it sounds like a self-serving answer, but we firmly believe that when you have guidance, if you're in an industry, it will become easier. Instead of saying, the entire universe of sustainability issues, where do I begin? You can rely on the rigor of our evidence-based research process, and that we involve members of industry in every working group. We have equal representation from corporations, from investors, and others. So we're not in an underground bunker somewhere just inventing standards. We're doing research, we're putting it out there saying, do you think that this information would be material to you as an investor, to your investors as a company? And we get 80% consensus. Generally, that's the average that we have. Are these metrics decision useful? Is there utility in them? Actually, yes. Are they comparable? Yes. So we're hoping that we're part of that solution. And to the question regarding the EU action, pushing that forward, I think it will. Although I said recently at an investor forum, I don't think the U.S. is going to join the EU anytime soon, but U.S. companies do compete with European companies. And so all of these movements, the WFE, the Sustainable Stock Exchange initiatives, all of these things are the horse is out of the barn, as my father used to say, not going back in. Genie's out of the bottle, not going back in. There is the time of less disclosure is over, and the time of better transparency, leading to trust and brand protection, is here to stay.
And I have two positives just to try to close on for myself on a high note. So one is, despite the dire nature of the statistics that I mentioned before, when we go and meet with companies, we're absolutely convinced that they're doing more with this than they talk about publicly. They're all using these metrics internally. They're all using to drive their strategy and their decision making. Now, convincing them to go public, convincing them to be more transparent with the investing world, that's been a struggle. But I do not think that most of corporate America is ignoring this risk or this reward opportunity. And then on the reward side, one of the things that we've seen in our engagements lately with companies is that there used to be a lot of openness about how they are driving their things like their energy numbers down. They are all reporting on a certain thing, and then we'd have companies talk to each other about the strategies they use to drive energy numbers down. They're not doing that as much anymore because they're starting to find competitive advantage in how they got to the number they got to. So they're turning the corner on the compliance side and seeing the opportunity side. There's a competitive advantage to managing this part of your business well, whereas there used to be a lot of openness about, we did A, B, and C to get to this number. It's more about, we did A, B, and C, but we think it gives us an advantage, so we're going to keep it to ourselves. I think once companies start to see the opportunity and not just the risk, and the opportunity and not just the obligation, it's going to be a real sea change.
Again, a note of caution. It's so boring, isn't it? I think you have to bear this in mind. You put out big, high standards out there, you'll be held to them, okay? So, for those of you who are in the corporate world, just be careful about doing that. We had a company not a million miles away from Macy's that held out the most extraordinarily strong commitment to ethical ideals, good business practices, and all the rest of it. And it wasn't mentioned in the keynote speech, but one of the big problems now in the world, because most sovereign governments are really after it, is the prevention of bribery and corruption, okay? And this company had on the one hand these avowals of great conduct, and on the other, an investigation which seemed to undermine it fairly fundamentally. And, you make a rod for your own back at that point. So I'm not saying don't be the best you can. I'm saying don't just say it, okay? That's the big point. That's it.
Thank you so, oops. Thank you so much. Don't just say it. You have to trust what they're saying. The companies, the reporting, the standards, the believability of it all. Wow, you know, I kept looking at Start with Trust. It rings true, right? Everything that you can, everything that our distinguished speakers have said, if you don't trust what's being said, nothing's going to happen. It's going to be damaging to your brand. It's going to then be damaging to the cost of capital. I liked that being drawn into it too, because anyway, I could go on. But let's not. Let's look ahead. And right after thanking this incredible panel, Evan, Katie, Laurence, thank you so much.